Bloomberg Audio Studios.
Podcasts, radio, news.
This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Carol Massar and Tim Stenovec from Bloomberg Radio.
U.S. hiring picking up in November and the unemployment rate increasing pointed to a moderating labor market rather than one that's significantly deteriorating. As the numbers look, non-farm payrolls rising 227,000 last month. That follows an upwardly revised 36,000 gain in October, according to the Bureau of Labor Statistics this morning. Smoothing out volatility, payrolls growth over the past 3 months averaged 173,000. It's a step down from the robust pace seen earlier this year. We got with us Michael McKee, Bloomberg News international economics and policy correspondent. Also joining us, Becky Frankowitz, Chief Commercial Officer and President North America for Manpower Group. It is one of the largest staffing firms in the world. Mike here in the Bloomberg Businessweek studio. Becky joining us from Milwaukee. Mike, quite a different report than we saw for the month of October, which was revised higher. Does it pretty much solidify what the Fed does later this month?
No, I wouldn't say it solidifies it. It gives the Fed no reason to not do it, but
hold on, no reason to not
cut rates.
Okay, there we go.
If we'd seen a really high number, and if unemployment had gone up even more, then you might have seen the Fed have second thoughts. We still have inflation numbers next week that could cause the Fed to have second thoughts. So we're not out of the woods. It's not a guarantee at this point, but this was not a terrible thing. The interesting thing in these numbers was the revisions and the fact that we didn't see a huge hurricane rebound. So you take away the revisions and you end up basically with a number in terms of job creation, in line with roughly what we've been seeing for the last 3 to 6 months, a little bit slower, but still fairly strong. And while the unemployment rate went up to a strong 4.2, almost 4.3, it's still below where the Fed thought we would be in December. So, it's not a great number, but not a terrible number.
I didn't hear you say Goldilocks.
It's hard to use that term because you're trying to pick a moment in time.
Yeah.
It's also, we're at the time of year when these numbers sort of get volatile, different, because they get affected by a lot of things. For example, we saw retail hiring fall by 28,000. Well, what's with that? Because this is the holiday season. Mm-hmm. It's a shorter holiday season. Retailers probably hired not as many people, but the seasonal factors that the government uses expected a big hire. So they pushed down the number more, and it comes out as a negative number, but I'm sure it's not really negative. We didn't see people get fired from the retailers during November.
So, Mike, some sources have said that this is a somewhat strong report, but not a consistently strong report. Can you just speak a little bit more to the details in terms of what you're seeing in terms of unemployment?
Well, the interesting things about unemployment is it's hitting different sectors of the society differently. It's hitting the unskilled more than the skilled. Black unemployment went up significantly, and white unemployment went up, but it stays below 4%. So you're kind of getting a picture of a last in, first out economy from the unemployment numbers. Now, that said, none of them are terrible or out of line with historical precedent. It's just that you're not seeing a movement in a positive direction for the most part. And the jobs that were created, the areas where we saw big job creation were in healthcare, which we've seen for quite some time, leisure and hospitality, restaurants. It's the time of year when everybody wants to go out. So we're not seeing any kind of big change in factory jobs. We had more factory jobs, but not a huge gain. Not seeing tech jobs grow a lot, which maybe we will in the future. But right now, it's a strong enough report, but it's not showing that the economy is bursting at the seams.
Becky Frankowitz, I want to bring you in here. Becky's Chief Commercial Officer and President over at Manpower Group. It's one of the largest staffing firms in the world. We got the BLS data, but you have this other dashboard of data that you see when it comes to hiring. Where are you seeing strength? And I think perhaps more interestingly, where are you seeing weakness right now?
Yeah, so thank you. I'll pivot off something Mike just said. I would say it was a strong report in very specific areas. And so what I mean by that is overall, it looks pretty strong. But when you dig in, it is very concentrated in the areas that Mike mentioned: hospitality, leisure, government, those kind of spaces. Basically, most other places it's holding, like IT, or its weakness. And so in the report, that's what we saw. When we look at our real-time demand, which is what you alluded to, Tim, we're looking at things like longer time to hire. That's a trend we're seeing underlying the economy. So in November, we've gone from 39 days on average time to hire to 49 days. That makes workers unhappy. Ghosting starts happening. That creates friction. Blue collar labor, which Mike mentioned as well, the real-time demand is down 9% in blue collar labor, with truck drivers, which we've mentioned as a top job in demand historically. Truck driver demand in new jobs down 45%. So we're seeing some underlying weakness that you have to dig into versus looking at just the headline number, which again, I would say was strong in very specific areas.
Well, Becky, we've talked a lot about different landings in the past, right? Soft landing, hard landing, no landing. Everyone's just hoping that we land. What is your latest read on what type of landing is even in the cards today after this data?
I think we're still kind of, sailing into a landing. I wouldn't say it's going to be smooth or hard. It's going to be slow. It appears that it's going to be quite slow. The first quarter of next year, by the real-time demand data we're seeing, is going to be soft. We're having to rethink retail hiring, again, discussed, but usually we'd see retail seasonality come in now, carry through the first quarter in terms of a decline. We saw big increases September, October. We haven't seen the increases follow through November, December. And so I think we're going to see an uneven recovery in the first half. And again, I think instead of soft or hard, it's going to be quite continued slow is what I would say.
Hey, Mike, we got the data from the BLS today, so we're sort of over that hump when it comes to understanding where the economy is. When you look forward to what the Fed still gets ahead of its next meeting, what is the next key data point that we need to have on our radar?
And next Wednesday we get CPI, and that's going to be the major number for the Fed. PPI will also give them some clues on Thursday. The day before the Fed meeting is retail sales, and we'll see how it fits together with hiring and wages and whether people are still spending money. It's just the retail stuff, not the services stuff, but we'll get an idea of what we saw at the end of November. I refuse to use the term Black Friday spending because that's just a made-up thing. But
wait, why do you say that?
Well, it used to be years ago the strongest selling day of the year, but the idea that it represents what's going to happen over Christmas, Hanukkah season is not at all correct. We've seen holiday shopping move into October. We've seen people wait until December's sales to actually spend money. What economists generally do is take the spending numbers for November and December and average them out.
Okay.
We make a big deal out of this as if it's some sort of signpost, but it's not really.
I feel like also, I don't know what you do, Nora, but it's like with a smartphone and with e-commerce, you're shopping when you need to shop.
Of course.
And it's like
your fingertips.
The days of doorbusters are totally over. It's a different world.
It used to be fears of people walking in, trampling people during Black Friday. It's like, oh my gosh, it's going to be so crazy. And now here we are, we're just going to our phones, waiting for Cyber Monday, Travel Tuesday. I mean, Becky, is this something that you also see? And especially as we're thinking about the holiday season, how are we viewing employment and just the labor market more broadly?
Yeah, so for sure, as we go into the holidays, we've seen holiday hiring come and go. That's behind us now as we sit here at the first of the month, which historically would not be the case. Why is that happening? Yes, shopping at your fingertips. Yes, omni-channel shopping. So I might run into a store. I'm going to do a lot online from my phone, sitting at work on my laptop. Those kind of things are happening, which actually smooths the season a bit. I think what we have to watch as we close the year is what the Fed will do. I have a little different view than Mike on that. I would say that this jobs report would give reason to hold. I think the Fed will still act because that's baked into assumptions in the market. And I hope in that action that stimulates more growth as we go into the first quarter. Again, that's not what we're seeing in the real-time demand today.
Big thank you to Bloomberg News International Economics and Policy Correspondent Michael McKee here in our studio. Also, Brecky Frankowitz, Chief Commercial Officer and President North America for Manpower Group.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Let's switch gears a little bit because the Chinese parent company of TikTok faces a ban in the U.S. if it doesn't meet a January 19th deadline to sell the video sharing app. It's the result of a federal appeals court ruling on Friday. A 3-judge panel in Washington unanimously upheld a new U.S. law enacted to protect national security and user privacy, ruling that it didn't violate free speech protections under the Constitution's First Amendment. We got with us Michael Shepard, Senior Editor for Technology and Strategic Industries for Bloomberg News. He joins us from our Washington, D.C. bureau. Just in the last hour or so, we have heard from TikTok. They're planning on taking this to the next step, which, Michael, is the U.S. Supreme Court. What could happen there?
Well, it's a great question, Tim, because TikTok has signaled all along that they view this new law, and even as the legislation was coming together, they viewed this whole move as unconstitutional. They see it as, in essence, censorship of their users across the U.S. They have 170 million at last count in this country. It's a big market for them, and they see this law as restricting their ability to not only do business, but for their clients or customers to express themselves. We all know how TikTok has been this outlet for so many people, especially young people, through the pandemic. Will the Supreme Court be sympathetic to that argument is really the main question. The 3-judge panel's ruling today was unanimous. The panel is made up of 2 Republicans and 1 Democrat in their ruling today. And the Supreme Court may not be any more sympathetic than the lower court was today.
Well, Mike, I mean, of course, with this ban, it's not good for TikTok or ByteDance, but of course, this can really help some U.S. companies like Snapchat, or maybe if we think about Instagram. I mean, these are some companies that will really benefit.
Yeah.
Alphabet.
Meta platform shares are went to a record high today.
Exactly. Maybe people are going to be going to Instagram Reels instead of TikTok. But what does this mean for the companies that spend so much of their money putting their ad spend on TikTok?
Well, Nora, I'm really glad you asked that question because this is a big business issue. TikTok has had this growing advertising presence here in the U.S., and it is also trying to develop a retail platform, a vehicle through which users can make purchases through the app. So there is a lot at stake here. And as you said, its competitors are feasting on the moment right now. And it will, it is something that actually the people who crafted the legislation, the Justice Department, in its arguments to the court, and even the judges who ruled today acknowledged that, look, we would be really sad to see TikTok go if it's not sold. We don't want to see it banned necessarily, but if that actually happens, there are other destinations for those users. So we might see some of those advertising dollars and some of that other business shift to these other places unless we see a sale.
Well, Mike, how quickly are we expecting a decision?
Well, they have to first actually make the cert petition to the court. We haven't seen evidence that they filed yet. And Matt Schuttelheim of Bloomberg Intelligence, one of our analysts here, does not expect the court to act on an emergency basis to overturn this. So it will be really interesting to see how the justices handle it. Do they take the case and then put it on pause and put the law on pause until they rule? Remember, they're in session until June or early July, so this could take a while. They also may just decline the petition altogether and let the law stand. So it's unclear how quickly they would act. It may not be before the end of this year, but we would certainly expect them to respond in some fashion before the January 19th deadline by which ByteDance must sell TikTok.
Does President-elect Trump, when he takes office on January 20th, does he have any influence over the fate of TikTok? Because he changed his tune, and perhaps one of the reasons we're talking about this now is because of what he did during his first term as president, when he was the initial person who raised the idea to sell its U.S. assets.
Well, you're right, Tim, and this was just an incredible turnaround for the president-elect. During the campaign, he reversed his position seeking a ban on TikTok. In part, he was using TikTok as a way to appeal to younger voters, but he also sees TikTok as a competitor to Meta Platforms' Facebook, which, as you remember, kicked Donald Trump off after the January 6th Capitol insurrection by his supporters. Now, that may be mitigated a little bit by Mark Zuckerberg's recent visit to Mar-a-Lago and his dinner with the president-elect. But at the same time, we haven't seen or heard from Donald Trump on this specific issue since the ruling came down. So we'll be all ears for anything that may come up on Truth Social about his position. And now whether he can alter enforcement of the law is another great question. There's not a lot of leeway or wiggle room for the Justice Department to simply take a pass on doing its job and following the code of law. We could see, however, the president-elect perhaps, if he still wants to see this ban reversed, go to allies in Congress to see if maybe there is a way to get the law revisited on Capitol Hill.
That's a good point. Michael Shepard, senior editor for technology and strategic industries for Bloomberg News down there in our Washington, D.C. bureau.
You're listening to the Bloomberg Businessweek podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Let's talk a little M&A when it comes to private equity, because Donald Trump's return to the White House is predicted to seed the ground for more big-ticket mergers and acquisitions. And dealmakers expect new appointees at federal agencies under Trump to bring a friendlier approach to M&A. We've heard a lot about that over the last month. The outlook for private equity and other deal making in 2025 is the focus of this week's CFO Briefing newsletter. We've got with us Nina Trentman, senior editor at Bloomberg News. She joins us along with Dorothy Walter, partner and CFO at the private equity firm Alpine Investors. Nina's here in the studio, Dorothy out there in San Francisco. You can sign up for the Bloomberg CFO Briefing newsletter at bloomberg.com/CFO Briefing. Nina, I do want to start with you and just get an idea from you how your sources have been thinking about the shift that we could see, that they could see come January 2025 under the new administration.
Yeah, thank you very much. It was certainly interesting to see in conversations this week, including with Dorothy, but also with other CFOs, to see that people, I think overall, are more optimistic for deal making. But they're not necessarily sort of expecting all hell to break loose. So I think the expectation is, yes, more deal making, potentially helped by lower interest rates, potentially also helped by less regulatory scrutiny that we might be seeing under the new administration. So I think an improvement from this year, and I guess we'll see where that leads us.
I mean, this year was pretty dry when we think about M&A. I mean, people have really been waiting for us to see the floodgates open and see some activity happen. As you're speaking to sources, what is the prediction? Is it going to be a slow run up into 2025?
Yeah, I spoke to Ernst & Young this week, and they were saying specifically on the private equity front that we should see sort of here in the US about 440 deals, which would be an improvement of about 15-16% over this year's levels. Interesting, I thought, was this, that they pointed out, well, the US is a bit of a leading indicator with regards to M&A. So if you see more deals here and more deals not just being announced, but actually being completed, that could also then lead to some more enthusiasm around the world. And I'm sure, Dorothy, that you can tell us more on this.
Yeah, I want to bring in Dorothy Walter, partner and CFO at the private equity firm Alpine Investors out there in San Francisco. How are you thinking about this change at the top when it comes to the top of the ticket, and thinking about another Trump administration? Because for the last few years, a lot of the folks we've talked to when it comes to M&A, they've essentially said it's the higher rates that have sort of put a damper on it. I'm wondering what you're thinking for 2025. Is it going to be rates, or is it going to be regulatory issues?
I think it's a combination of both, and nice to be here with you all. We've heard all the dire news, all the 30% count of deals down year over year in the United States. It's looking bad, but then there's so many bright spots as well, right? Transactions and $10 billion of value and more are up year over year. Average deal size is up year over year. Mega cap sponsors are very active in the market, which we're certainly keeping a pulse on those deals. 25 of them happening year to date. And on the IPO side, we have some bright spots on the horizon. HG just announced potentially thinking about taking Visma public after holding that company for a super long time. And so we're pretty optimistic. We think some bright horizons are coming.
Dorothy, talk to us a little bit about Alpine, sort of the investments that you're looking for. I know that you've been pretty active on the deal making front this year already. Talk to us a little bit about that.
Yeah, that's right. I mean, while those stats overall for the United States deal making are down year over year, Alpine's been up year over year. We've closed over 160 deals this year and coming. And the reason is we just hunt in a different pool than other sponsors. We don't let the game define us. We define the game we want to play. For our platform deals, we transition management 100% of the time, which means that we can look in different pools. Over 80% of our deals over the past 5 years have been proprietarily sourced. And that allows us to really try and set a different tone for the market.
Dorothy, are there any sectors or industries in particular that people are thinking are more primed, more fertile ground for some transaction activity as we head into next year?
Certainly industrial, certainly tech. I mean, with where the elections are going and some of those headlines, those are pretty hot right now. It's yet to be seen, where regulatory changes are going to take us. Like, are Vivek and Elon going to be effective at their Department of Governmental Efficiency efforts? Who knows? And then with those efforts, how is that going to impact different sectors that might become hot or not hot, for example?
I think one thing, of course, will be interesting to watch also, Dorothy, and maybe you can comment on that, is this: how do deal makers think about the environment for deals, not just on the regulatory side, but also what will the market confidence look like? Because, of course, some of the deals will also happen if the environment looks good and if there's a positive sentiment around that. Talk to us a little bit about that.
Yeah, I think that sentiment does play a lot into it. I mean, we've been through a lot in headlines over the past 2 years with various wars and macro uncertainty. And so while I don't necessarily think that will all be resolved, we think that the increased investments by this new administration are going to really allow us to have more confidence in general support in the U.S. for business sentiment overall.
What does the landscape look like for opportunities? Like, when you look out there to see companies that you think look like ones that you'd actually add to your portfolio, what are the characteristics that they have?
A lot of them are recession resistant. So
Okay.
we really look at the top line trends over time, make sure that that's very strong. As I said, if we're replacing management, we're often we're cultivating relationships with these company founders over many years, right? And so understanding what it is that they've been through to build that company, where they think the future of that company is, and then making sure, again, that top line is strong enough to withstand a management transition, and that also those customer relationships are strong enough, right? And so I think we think a lot about those pieces. We also think about fragmented, deep markets where M&A can play a big piece. And so one of the things, we've been talking about M&A volumes. I mean, let's look at the lower end of the market. There's still a lot of smaller deals trading in 5-10 million EBITDA space that can supplement a strategy for a company. They can build out different product lines. They can build out greenfielding new geographies, right? And so those are some of the aspects that we look at that make deals attractive for us, and where Alpine can bring its value creation playbook to play, whether that's on M&A, whether that's on various other value creation levers we bring.
So how are private equity firms thinking about potential M&A transactions in 2025 if the Federal Reserve doesn't cut as much as people are expecting?
It's been interesting for us just looking at the dynamics in private credit markets. So looking at, for example, BlackRock's recent acquisition of HPS and how that's creating this really imbalance in demand and supply and the provision of credit. And so while rates are certainly one thing, the availability of debt is another thing that we should be really talking about. Alpine looks at things such as like our DDTL loan terms, EBITDA definitions, those types of things to gain competitiveness in the market. And really for strong top quality assets, we're seeing quite a lot of demand out there and very little supply. And so what that means is continued ability to make deals where you have some of those compelling characteristics that I just shared.
Dorothy, we'll have to wrap up shortly, but just talk to us 1 second about valuations. Have those come down?
You can't say with broad strokes. There are certain industries that have certainly been very impacted, whether it's by governmental regulation, whether it's by other macro headwinds. I think, and then there's others that have benefited and that have seen, been able to ride through COVID and continue that wave. And so I would say valuations, you really have to poke at them, and you have to know when you're talking to your sponsors that you've invested with, like, how are they approaching those? Because some of those public market benchmarks are pretty old by now, and so we're waiting for a public market to open up again to start to establish some new benchmarks for us.
Dorothy Walter, partner and CFO at the private equity firm Alpine Investors out there in San Francisco, along with Nina Tretman, senior editor at Bloomberg News. She writes the CFO Briefing newsletter. Sign up for it now. Just head on over to Bloomberg.com/CFO Briefing.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's the question that drives us.
This is the Drive to the Close
That funky music will drive us till the dawn.
on Bloomberg Radio.
It is about that time. Look at that. 18 minutes roughly until the close of U.S. trading on this Friday afternoon. Taking a look at the S&P 500, up to close to 0.2%, off the best levels of the day, but still in the green. The NASDAQ higher by 0.7%, also around its best levels of the day, I should say about that. The Dow is down 0.3%. Look at that. It is time to drive to the close. Let's bring in Megan Horniman. She is Chief Investment Officer over at Verdance Capital Advisors. She joins us from Hunt Valley, Maryland. Megan, how are you?
How are you? Good, thank you.
Yeah, we're doing pretty well. Sort of trying to figure out what 2025 looks like. A lot of folks now thinking about, okay, well, if the S&P 500 was up more than 20% in 23 and 24, what is 25 going to look like? There's a lot of kind of factors at play with the new administration coming in, people thinking differently about interest rates. What are you thinking?
So I think we could start with interest rates, especially since we got that jobs report today, and that was one of the final pieces of information, aside from the inflation data, that the Fed needs before their next meeting. And I think from an interest rate perspective, it doesn't change the fact that the Fed will cut interest rates in December, but it does make 2025 look a little bit less certain, and that's because the inflation continues to be the sticky story there. It's something we've been talking about, that the sticky part of inflation, so whether it's housing, whether you look at the wage number that we got today, services, all of this is still problematic for the Fed, and it's something that they can't control. So we were a little concerned when they went with the 50 basis points in September. This is something that was a little aggressive in our opinion, and the biggest risk was it reigniting inflation. And what we're seeing right now is the inflation progress is basically stalled. So this is going to take, it's obviously pulled some of the rate hikes off the table for next year. Right now we think there will be a cut in December and then a pause and reassess the situation, see how it goes into 2025. From an equity perspective, I think that 2025 it can be a positive year, but don't expect these double-digit types of returns. Expect more muted returns next year, and that's because we think the earnings situation, the earnings environment, is just it's pricing in way too much optimism for the economic situation next year. And I think the economic situation is going to be a bit weaker than we've seen, and that's going to put some pressure on the earnings growth. So we are a little bit cautious going into 2025 from an earnings perspective. Equity perspective. Remember that it's also the third year of a bull market. That does tend to be one of the weaker years in the bull market, loses steam there. And it's the first year of a presidential term, which history tells us that's actually the most chance that you get during a presidential term for recessions. So I think that the equities, just expect more muted returns next year.
Megan, it's interesting that you just bring up President Donald Trump, the new elect here. I mean, we did see the Russell 2000 posting its best return this year on optimism about Trump's campaign promises. Is now the time for small caps as we look at 2025?
Well, small caps are, from a valuation perspective, more attractive than the large cap space. But this run that we've seen in the small caps is totally ignoring the fact that, A, they can be interest rate sensitive. And we just talked about how the Fed's not going to be able to cut interest rates. And there's a risk that, the interest rates could move higher, not necessarily the Fed funds, but because of inflation, you could see higher interest rates. So this is something that, they're taking too much, I think, into the small caps. It's looking too much into the hopes for economic optimism. And then being that they're more domestically oriented, they can do better if we start talking about tariffs. But it's totally ignoring, the valuations right now are ignoring this negative fundamentals that we see here from the small cap perspective. So I think you'll have a better entry point for small caps.
What are the red flags out there? I mean, I'm talking to folks, they're friends of mine who were around during the 1990s, and they look out across the landscape right now. And, they've seen the cycles there, and they say, I'm starting to think that the valuations we're seeing, we're not quite at the pets.com and Webvan era, but I'm a little concerned about valuations that I'm seeing. How do you look at that?
I agree completely. I mean, we're looking at 26, 27 times earnings for the S&P 500. That's a significant amount of valuation or PE expansion that we've seen this year. Can that continue for another year? I'm not so sure. When you look at that, it's pricing in perfection, in our opinion. It may not be exactly at the dot-com bubble levels, but you are looking at equity valuations that are stretched. So it's pricing in this very optimistic outlook for not only economic growth and a soft landing, but also that the Fed can, just continue to cut interest rates. And I don't know that they can continue to do that into next year.
I mean, there's so much data that we're tracking, especially as we think about the Fed and when it may cut and how many times they may cut going into 2025. What are you really focused on? Is there any particular data point that you are keeping an eye on as we're going through these next few weeks into the end of the year?
One of the things that obviously the headline inflation numbers are always important, but also look at some of the underlying inflation numbers in things like the ISM manufacturing or the ISM services index. That ISM services index has a prices paid component, and it came out this week, and that was higher again. So this is something that you're seeing in those service inflation numbers, and that's a concern for us. So we look at some of those underlying inflation indicators. The other ones are consumer inflation expectations. And we saw today that the one-year consumer inflation expectations jumped up again. This is concerning for us as well from an inflation standpoint. I think that's what the Fed's going to be looking at as they try and assess what to do next year.
So how does that look? How does that, look at when you see the incoming administration? And we talked a lot about this week with Jay Powell, and what we heard from Jay Powell earlier this week. But if you do have an administration that comes in and ends up following through with what it talked about on the campaign trail, including deporting millions of people who are here undocumented, and also implementing tariffs, do you see the inflation picture changing?
I think there's upside risk there to inflation from a tariff perspective, and the estimates really range broadly for what that may mean. And let's see what he comes in with when he actually does come into office and what those tariffs may look like. We have a kind of a playbook of what happened in 2017 and 18, and we didn't see a very big impact from those tariffs in inflation. But we are in a very different inflation regime now than we were back when President Trump's first term. So it's the Fed's walking a very fine line, and they can't control that from the government standpoint. So I think it puts some upside risk there to inflation.
Hey, Megan, before we let you go, you get new cash right now. How are you deploying it? Just 30 seconds.
I'm looking at municipal bonds going into next year from a taxable equivalent yield perspective. They're attractive. And I think that you'll see, even with the Tax Cuts and Jobs Act that's expected to sunset, I think we're not looking for much lower taxes here anytime soon, especially with the deficit situation. So I think that municipals have a good opportunity right now.
All right, Megan Horniman, Chief Investment Officer over at Verdence Capital Advisors, joining us from Hunt Valley, Maryland this afternoon. Megan, always good to check in. Have a great weekend.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.